If you guys are not familiar with the interest rates on some of the videos that I mentioned, it could be a devastating trap. You could spend $200, $500, $800,000 and you can see the balance probably barely moving. What can I do? Especially if you're someone who's done a fixed income and had a huge, major, unexpected expenses coming up, it could be very detrimental on you making your progress and maybe putting you setback. Now, there's other very specific debt relief programs that you can use, like consolidation loan, consumer credit counseling, bankruptcy, and some type of negotiating called debt settlement. In this video, I'm going to talk about specifically about debt settlement, reducing the balance of the credit cards, negotiating them, and having a company doing it on your behalf. So what is debt settlement to start off? It's basically a hardship-based program where basically you hire a company to negotiate the total balance on the eligible debt that you have. Usually it has to do with unsecured debts. For example, unsecured is like credit cards, personal loans that are not tied to a car, lawnmower, TV, or house, or medical bills, private student loans, in between those lines as well, that basically is just tied to your credit. Let's talk about some of the advantages of doing debt settlement, where we basically negotiate and settle the balance of the creditors. Basically, the payments that you are going to be paying on the minimum, supposedly if you're someone who's current, is going to be close to cut in half, or very similar to what you'll be paying, but it significantly reduces the timing of what you pay off the debts. Now, if you're not very familiar, why would a creditor negotiate the balance with the company versus just making minimum payments where the payments can last you 10, 15 years? That's a really good question. Now, the very important thing that I mentioned is that it's a hardship-based program in the beginning. The reason why it's a hardship-based program is because the creditors are notified that the consumer who's going through the program is going through two things: financial distress and can't afford the minimum payments. So one of the things, if you did talk to one of these previous companies before, they're going to tell you to stop discontinuing the payments, and the account has to be closed off.
What did he say?
Now, why is that? Because that could sound a little bit daunting and scary to someone who probably never heard of the concept, or someone who made perfect payments in the past, never missed a payment. The reason why when you do some type of negotiation or settlement with a company is because it indicates to banks that you no longer can afford their minimum payments. So those accounts will no longer become profitable at the original principal amount on the given balance on the credit card, personal loan, medical debt, payday loan, or private student loan. So in return, it will motivate the creditors to settle the balance with the company at a lesser amount. Because the banks, they don't really care about like how the debts got there, regardless if it's COVID, divorce, job loss, or retired, veteran. Regardless how high the payments are or interest rates are, it's fair to say the banks as a business, they don't really care if someone is struggling financially, if they're going through those expenses. But at the end of the day, it's fair to say, just like most businesses, they rather take some money versus no money, like bankruptcy. So that's what's giving the ability for company on your behalf to negotiate and settle the balance behalf of the creditors, because technically you're shifting your payments towards another company to negotiate to settle the balance on your behalf on the available funds that you're giving. Now, the funds that you're giving every single month is not going directly to the creditors. They actually put it in what it's called an FDIC insured dedicated account. It's a very fancy way of saying it's a special purpose account that's going to pay off all the unsecured debts that are eligible that's in the program. They're technically going to build that up until enough funds are built up, and they're going to basically reach out to the creditors to say, let's just say my balance on a Chase is $1,000. They're going to reach out to Chase and say, hey, let's settle for $500. We have X amount of funds. This person can't afford the minimum payments no longer, but they can afford $500, and this is how much funds this person has based on X amount of months of funds that they put in. Usually the creditors don't want to say no to a settlement just because they'd rather not have a person actually claim bankruptcy or take them to legal action. And I'll talk about legal aspects just a bit, just because it's costs us so money and they have a possibility of losing a lot of profits to it. So even if it's a lesser amount, they like to settle. It's because it's so expensive for these banks to keep an account actively open, trying to recoup the money that they have. So it's very more profitable for them to actually settle the balance. And usually they just write as a tax write-off business loss on the banks on their side. What will happen with the interest rates and fees and the late charges that are going to be building up if I discontinue the payments? So usually when companies have like a monthly payment or biweekly payment, depending on like how your pay schedule is and what kind of program payment schedule that you want to go into, is usually built into all the late fees, the interest rates, and all the aspects of paying off the debt from A to Z. Due to the company's experience, knowing who the creditors are, the balance is, the interest rate, the fees, X, Y, and Z, they pretty much cover everything. So it's pretty daunting if someone who is not really familiar with the aspect of a settlement, but the company knows how pretty much what these creditors want, the dollar amount, and the relationship that they have with the creditor, just knowing the fact that they paid so much huge volume to it. So they tend to just able to settle during that time, just through the experience and the amount of available funds that you're consistently getting. Now, if you're someone who is very, very tight and cannot do those given payments to it, then it gets a little bit tricky on the timing of the settlements that you're going to get. You also want to put as much funds into it because there's no penalties on adding extra funds on that dedicated account that they have. That's what I mean by special purpose account. It's very similar to like an escrow account in a say. So they have enough available funds to play around with, to utilize it, because the banks talk with when it comes to money and funds. Now, when it comes to creditor calls, you will still get calls regarding to creditors just because it doesn't change the fact that you still owe the debt. Even though they know that you're working with a company, and banks, they tend to lie that they haven't got reached out by a settlement company, just because their job is to solely collect the money. And you got to look at it as a business aspect as a creditor. For them to get you back in good standing and keeping the payments current is much more profitable versus actually having a settlement. The creditors are actually making a conscious decisions business-wise on what's being more profitable. So you still get the creditor calls regardless, because it doesn't change the fact that you still owe the debt. You're not doing anything essentially wrong. I know the whole aspect of like missing the payments could be, like I said, scary or fearful in a sense, but these creditors are getting contacted and getting reached into the settlement. It's just that they have so many accounts, so many clients at the same time that they just don't really track very detailed individual person by person on what kind of programs they are, if they're in a settlement, whatnot. And like the bank's whole job is to collect the money regardless how the debt's got there, regardless if you can afford the minimum payments or not. It's just more profitable to reach out to you and get you back in good standing in a creditor perspective. The phone calls will kind of die out around 3 to 6 months as it goes to potentially, depending on the creditor, going to collections or debt collector, and they'll still reach out to you, those companies, but the phone calls died out as the settlements do reach and pay off it through the settlement, and they have to report it to the credit report. Usually the settlement companies pay by the end of the month just because they don't want to pay off the settlement if it's on the 1st, the 15th, the 20th, and do it for each individual person. Usually the companies like to do it at the end of the month so they know what available funds that they have, and they just send a bulk settlement. So let's just say you have a settlement with Capital One. They usually pay it off at the end of the month with other Capital One clients that they have available, so they can just pay it off all in one rather than trying to pay off the 1st, the 15th, and 20th. So if you're still getting calls even though you reach a settlement, that's the reason why. Now, if you get a potential lawsuit, it's very likely it's because depending on the creditor. Creditors that like to do that very often is like American Express, Discover, what the industry define as aggressive creditors. Now, if you have some creditors that haven't reached a settlement almost like a year or 2 years, they could potentially put you in legal action. But usually they don't want you to take you to a small claims court just because it's just such a hassle to hire an attorney, get an attorney to actually go to the state and the county court that you actually belong to and try to get a judge to actually approve it. So usually they do it just as a scare tactic to see if they can get the money. Like I said, the whole aspect of the banks is try to get you in good standing or trying to get some more money up front rather than reach a settlement. It's more of a scare tactic. Now, you also want to get a company that does legal protection. There's some companies that are out there that doesn't put legal protection on your biweekly or monthly payment, depending on the payment schedule that you desire. So it's very important to ask the consultant and look into the documents that is, if there is legal protection onto it. So if it does reach legal protection, what you kind of want to do is actually send a file or a copy of that document if it's related to a law firm. So the company that you hire can use their network of attorneys that they have available, so they can reach out to that specific law firm that has that account, so they can actually negotiate with them and settle the balance through there. It's more of a scare tactic that a creditor uses for the consumer, just so they can see if they can get a large sum of money through that way and get some more profitable direction of going that way. It's very kind of predatory that they do. I'm not going to name a specific creditor, but they tend to do that just so to get some money and fear within a client. And the timing of the settlement will just really depend on the creditor, depending on what kind of relationship that settlement company has. Usually companies will start off the smallest funds, or depending on like what kind of creditor you have available. Usually aggressive creditors, they don't like to settle right away unless the amount is like pretty small. Like I said, like Amex, Discover. Usually they go with the creditors that with the lowest balance or that has the best relationship. If you're doing a 48-month program, you're gonna see, depending on your creditor mix, about like your first settlement within the 90 days on one account, and possibly two accounts, depending on like the mixture of credit that you have, just because there's a lot of variables that comes along with this as well. And then usually the second settlement or third or fourth settlement should come around 4 to 6 months. Within your first year, you should have a structured settlement on most of the accounts that you have, or most likely have. But usually about the second year, you should have all the accounts on a settlement structure. And basically those payments that you have, that you're putting on the dedicated account, is going to be pay off the creditors. What's going to show on the report is going to be either paid in full, settle for less, and that amount. Once the balance is paid off through a settlement, needs to report that to the credit report that the balance has either, like I said, either settled, paid in full, and show that that is a zero balance. It's going to show that the accounts are delinquent during that time while you're going through a settlement, but it's not going to show like bankruptcy that, hey, this person missed all his payments. It's going to show like all of a sudden like it was like a delinquent, loss, and settled, paid in full. Now, what's going to happen to your credit is going to be a dip around like 10 to 15%, because you're going to utilize about 35% of your available credit profile, which is the payment history. That's going to basically close all the trade lines to it. So depending on like what kind of credit habit you have, it could go down significantly. I can share you a little bit about my experience. So I went from a 650 to a 500 something. I don't know if it's a quarter 500 or mid 550 or whatnot. Then 6 months later, it started going up, because around 6 months, it's going to show a couple things: that the account is closed. It doesn't change the fact that you still owe the debt. And around that time, the settlements are going to be built and the balance is going to be paid on full on some of the 2-3 accounts, depending on the credit mix that you have. It's very similar to like the dip, as if when you buy a house, then it goes back up later on, because it's going to show on the credit report that the balance is paid off, regardless if it shows settled or paid in full. When you do apply for a car or a house, the banks, they don't really look at like what you did the past 7 years. All they really care about is what is the person's credit score, the debt to income, and do they have some money down, depending on what kind of purchase you're doing, of course. And does this person has the financial means, the debt to income, credit score, and money available in the bank in order to become lendable. So it's not going to prevent you like for 7 years, like utilizing your credit. I had a friend of mine who went through the 4-year program. Within 3 years, he was still able to buy a house, even though he was doing the 4-year program through a settlement, because the banks, all they really care about is what your credit score is, what's the available funds this person has, and the debt to income ratio in order to become lendable. So while you guys are going through the program, you can do it, but it's very important that this is not going to happen to everyone. Depending if you're like retired or in a fixed income, your budget's really tight, or someone who has decent enough of disposable income each month, the banks are going to look at your debt to income and to see if you're paying like other stuff as well, like car insurance, electric bill that's either in your name, because the creditors look at those. As long as you maintain good credit behavior while you're going through the program, it's important to indicate that you are still lendable. But if you're someone who is still missing electric bills or car insurance, which it's going to show up on your record, it's important to maintain good credit behavior as you're going through it. And you can always open up a new credit card as you're going through the program after like 6 months or 2 years, as long as you maintain good credit behavior, not going over the limit. That's what's very important about going through a settlement. It sounds daunting, getting creditor calls and missing the payments, interest rate and fees are going up. But as long as you stick with the program, I always tell people you need to fulfill the program terms so you get what you deliver. If you're one of those people who are like impatient and expecting after like 4 payments, 6 payments after a year on a 48-month program that it's going to be all wiped up, I think you're setting yourself a little bit unrealistic expectation, or whoever the company is didn't deliver what they're supposed to say, which is the realistic expectation. I went through the program myself. It's a tremendous program. I have friends, family members that are going it. It just takes some time because the debts weren't built overnight. But as long as you stick with the program, if they're a reputable company, they have legal protection, go with the company that you know that has good experience, or friend or family or acquaintance that you know that went through it, and you'll just have a tremendous result as well. Just make sure you maintain good credit behavior so you can put this step behind you, live a full, strong financial lifestyle from that point on.